When it comes to your investments and retirement, in this economy, it's important to be smart. And with the Smart Investor Hour heard right here on AM 1420 The Answer, you'll get both smart and intelligent information you'll need to help with your investing. So sit back, listen, and learn with your host of the Smart Investor Hour, Tim Hayes of RBC Wealth Management.
Good afternoon, everybody. Kind of a gloomy day, so grab a cup of tea, cup of coffee, and let's talk about a few things. And first, if I may, the world's in upheaval, and I'd like to make a shout out to some of our servicemen and women. So these all come from. I had a great conversation this week with a guy that went to was a Ranger, and I'm going to use him as the last quote, but. If I just may talk to these people, you will never be anything in this world without courage. It is the greatest quality of the mind next to honor. Ain't that the truth? Strength doesn't come from what you can do. It comes from overcoming the things you once thought you couldn't do. And then finally, this is from my Ranger friend. His drill sergeant told him this. You might screw up. You might even fail. But never, ever quit. God bless our servicemen and women. All right. Anyway, so, it was a tough week. And what I thought was interesting is I was listening to Lori Calvasina, who's our head strategist, as you probably know if you listen to this show fairly regularly. And I thought it was kind of interesting, despite these macro headwinds that we're seeing. And look, I've been doing this a long time, and I haven't seen so much, stuff, that's it's this big headwind in the, you're climbing uphill almost, okay, in the markets. And, you got a 5% yield on the 10-year. You've got Ukraine, you've got Israel, you've got, politics, and, and you've got a Fed that is tightening things. So it's tough. But with all this happening, Lori says the rate of upward earnings per share estimate revisions for the S&P 500 has turned slightly negative in October. That was the slight bias upwards that she saw in August and September. So she's actually seen a little bit of cooling on the earnings sentiment as a positive development as the third quarter reporting season gets into full swing. That being said, she's concerned that two of the sectors that have been particularly noteworthy fade on this metric are industrials and materials. So we're keeping a close eye on that commentary going forward, and we'll keep a look. But after she upgraded her earnings last week, so on the review of the S&P 500's call transcripts from September, the macro is starting to take a toll. Okay, so companies continue to emphasize the resiliency of the consumer, who has become a lot more selective in their spending. So we're reading about macro uncertainty, inflation, interest rates are impacting demand and spending. So it's more on the corporate side right at the moment, and so pricing commentary remains mixed. There's a fair amount of emphasis on how it's moderating. Okay, labor force reductions as a cost of saving mechanism is another theme that's jumped out. So we haven't heard about that in a while. And she searched on the impact of the resumption of the student loan payments to the Russell 3000 companies, and finds there's very little direct commentary on that issue. So we'll see what else she says. But some other things that stood out to her, I think, are pretty interesting. Large caps no longer have an advantage over small caps on earnings. So revision trends, and she looks at this stuff, have hit both of them. So this is, believe it or not, is positive for the beleaguered small caps. Small caps, ever since October of 21, which, Rob Schleimer made a good call there. He said they broke down, which looked deeply undervalued, by the way. Uh, they've been lacking a catalyst. And in recent meetings, we have emphasized that equity investors need to get more confident the Fed cuts are coming, and a recession could be avoided for the small caps to lead again. They usually lead out, so we'll just leave it at that. And I mean, look, we've got a darkening geopolitical backdrop and domestic political dysfunction in Washington. So we're stunned that the AAII net bullishness was at plus 3.5 in favor of the bulls. All right. So people aren't bearish enough yet. All right. That may happen soon, but it's not right now. So this explains the ongoing difficulty equity investors are having. They're trying to price all this into the market, and we had a decent start to the earnings season, which eased the interest rate fears a little bit, but then the interest rates kept going up. So, look, I'm not an expert in interest rates, so I'll just leave that alone. But U.S. equity flows have deteriorated again into negative territory on a 4-week basis. So the money's coming out again. Bond inflows have continued to fade because nobody knows where the top is. And global equity and bond fund flows have turned slightly negative also. So within large cap, passive flows are fading. So nobody's buying the indexes anymore. Growth flows have turned negative, and value outflows are worsening again. So every category of small cap flows we track have worsened. At the sector level, consumer, financials, industrials are all worsening and or have turned negative. And the only bright spot in the U.S. Data flows where trends are improving in our energy, telecom, utilities, and REITs. And I think utilities and REITs, we always talk about buying yield when it's down. And that's probably what people are thinking. They're kind of hiding that way. Outside the U.S., Canada, Australia, Japan equities are seeing flows improve, but European equities and China are still seeing deterioration. So, it's tough. We're in this narrowing path. I mean, we looked at the S&P 500, and this is the most narrow an up year has ever been as far as the number of stocks participating, and so there continues to be a diminishing possibility that the S&P 500, perhaps a lot of other developed markets could post new highs in the next few months, as long as faith is so-called soft landing is occurring. But beneath the surface, the spending power and confidence of the U.S. consumer are under pressure. That's what's been holding the market up. All right, so look, it's compressed by deleted savings, higher interest rates, a growing unwillingness of banks to lend, and energy costs are up. So that's all stuff that could be a problem going forward. So this narrow leadership is a problem. Now, look, I'm going to make a comment here. If you don't have a plan, these are the times where you're not sleeping. I highly recommend a wealth plan. Wealth management's important, and fortunately, in times like this, what I can do if my client wants is I can go and do a what if. I can go to, there's a thing called Playground that we can do a wealth plan for you as a prospective client. If you're a client, what I can do is say, okay, what happens here? All right. So, how can we fix it? That type of thing. And so we could do what ifs. All right. And this is when you need them. This is when you need to understand, to feel confident that things are going to work for you. Okay. So I just mentioned that simply because I mention it every week, and there you go. So, in Toronto, we have a gentleman by the name of Sean Killen, and he wrote a piece just recently about the opening acts of a recession. And it's hard to pinpoint the actual start of a recession, and that's one of the things. So the question is, are we going to hit it? Now, we've had a lot of spending. We've got a lot of government spending going on. So the soft landing scenario is still in the back of everybody's mind, but it is a consensus viewpoint. And I'll be darned if I can remember the last time the consensus was right. All right. So, look, the majority, uh, let's put it this way. Since the onset of major central banks' monetary tightening campaign started in the first half of 2022, the probability of a recession has risen. And a lot of the attention has been focused on certain risk factors that portend a possible economic contraction. Now, we talked last week about calm, how we have we look at 6 indicators. 2 are positive, 2 are neutral, and 2 are negative. So, we don't see it, but I think when recession risk starts to increase, short-term yields rise higher than long-term yields. That's the way it's been for a while. Now the long-term yields are turning around. So it's interesting. The interest rates are going to take their toll. The question is, how long is it going to take for them to do it? Because they do take a long time. So, look, this narrow leadership that we've been talking about, the trend continues. I think there's the Magnificent Seven, as they call them. You look them up. But there's 12 stocks that are responsible for like 160% of the gain in the S&P 500 this year. So the average stock is flat to down. The Russell 2000 is really ugly. So, and even dividend stocks, which have usually been, good places to hide, have been getting beat up. So, and by the way, when yields up and those stocks are down, that's when you want to buy yield. I'm not saying today's the day, all right, but you might want to look at like our dividend growth portfolio, our prime income list, and all you have to do is go to WHK 1420, local podcast down to the Smart Investor Show, and they have all sorts of contact me, email me, and look, while you're there, under Insight, the top column there, they have Insight, and they've got a lot of good stuff. They have two new pieces in there that I highly recommend. I'm not going to talk about them. You go look yourself. And then under Bulletin Board, it has some of Rob Schleimer's stuff. He's our head technical guy, and he's been a good guide. And we also have our weekly newsletter there, so something to look at. But I think, look, dividends are important. They've been 40% of the gain in the S&P 500 for the last 60 years. So, you want to look at them anyway, whether you buy them or not. That's up to you. I just think it's important that you buy yield when it's down. So, but I think, if you look, these Magnificent Seven have been, basically most of the return, and that's narrow leadership. Matter of fact, as our people have said, twice now, and if you wanted these reports, sure, we can get them out to you. It's the most narrow market we've ever had, and there's 7 stocks that have contributed to the S&P 500 returns this year. Fortunately, I own several of them, which are good. But it's a narrow market. It's a tough market. So the question is, when does it bottom? And I thought it was interesting. We had a healthcare conference, and Lori Calvacina, our head strategist, has been talking about the healthcare stocks, and they just haven't caught a bid. So we'll see what happens going forward. But I think it's important that we take a look at where we are. And like I said, check your blind spot. Okay. So most people right now are, wondering what the heck's going on. I got a lot of cash in a lot of my accounts, or I have a lot of stocks that we've owned them for a long, long time. And, last thing you want to do is gain capital gains in a year like this. But remember, back when you driver's training, you signal, you look at the mirror, you look over your shoulder. All right. So that's the smog is what they call it. It's been drilled into our heads of any student driver over the years. And it's an attention and a second nature to check thoroughly before switching lanes or turning. Okay. So where is your blind spot? And that's the key. Traditional investment research is focused on financial data ratios to understand how a value a company stock. Things like revenue, earnings per shares, dividends are all great places to start. And in recent years, companies have increased their disclosure. And, so there's extra financial data. So, I could talk about case studies and all that good stuff, but the point is that, you've got to look at other things that affect these companies, because it's not just the company, right? It's the economy, it's their customers, it's the consumer, et cetera, et cetera, et cetera. So, I think right now is an important time to check your blind spot. All right. So, a couple things. Wealth plan right now, I'm telling you, the people with a wealth plan feel much better. I still think we're going to make it through this okay. It's going to be tough because look, there's been all sorts of things going on, and it's tough to keep a positive attitude for the long run. I've seen times like this. I've been through times like this. Okay, and it's tough. And you're in a tunnel right now, and you can't see the light at the end of the tunnel, but it'll come. It'll come. All right. It's always darkest before the dawn and all that good stuff. But remember, where is your blind spot? If you have a wealth plan, you might know at this point. Okay. There's all sorts of things that we could talk about, but I think, look, there's in times like this, I think you maybe it's time to have an appointment and talk to me about some things. So anyway, we're going to take a break here, and we'll be right back. This is Smart Investor Show. Stay tuned.
Making your way in the world today takes everything you've got. Taking a break from all your worries sure would help a lot. Wouldn't you like to get away?
My first ride along was with Jamal, even before I was hired. They wanted me to see everything from the ground level before moving forward, and it was awesome. The first time I came in, I got to sit in on a meeting and never realized that plumbers have that level of organization and sophistication to their operations. And I say that as a former degreed project manager as well as an Air Force vet. After getting out of the service, my wife and I moved to Cleveland, and I just wasn't happy with the corporate-style desk jobs. So I prayed for a sign. That next morning, my best friend called me about this radio ad on the Fish for a company he thought would be perfect for me. And he was right. Wyatt Works was a godsend. You have to want to help people. But if you do, this job is fulfilling in ways that the right person won't find anywhere else. If you want that for your life, call us direct and
consider it done at WyattWorks.com. License number 30185.
Wallacadoodle.
This is Dennis Prager. Now you can listen to my show when it's convenient for you and without censorship from big tech. Become a member of the ultimate online community for all things Prager. It's Pragertopia Unlimited. Listen to every radio show over the last 10 years, all commercial free. You can even listen to all my Torah teachings for free. Join today and save 25% off the first year and get a free Pragertopia coffee mug. Go to Pragertopia.com or click the banner at DennisPrager.com.
At RBC Wealth Management, we are proud of our reputation for putting clients' interests first. Our steadfast commitment to helping clients achieve their financial goals includes giving back to the communities we serve. Through supporting youth education, human services, and the arts, we hope to make tomorrow better for everyone. Call Tim Hayes at 216-774-8906. RBC Wealth Management, a division of RBC Capital Markets, LLC, member NYSE, FINRA, SIPC.
Okay, we're back. I was just looking, and there's a piece out that several people have asked for, and which is unusual because it usually takes about 3 or 4 weeks for people to ask for stuff. But it's called "Taking Control of Healthcare in Your Retirement." Healthcare costs tend to be a third of what you spend in retirement. So this is a good way of planning. Look, Planning can help you rein in medical expenses and keep you financially fit. That's simple. And I think it's important that you understand that. So it's available. We'll leave it at that. I had a lot of questions. I've been having a lot of questions, people calling in, and I pick up the phone, by the way, and asking me questions about the dollar and it going digital. And I don't think we can afford to do that yet. Look, what we want to do is keep the dollar as the reserve currency. It allows us to print money, and if we didn't, most of our politicians would be in trouble, I think. But the point is, it's the dollar right now is our reserve currency. So digitalizing it, I don't think would go over big with a lot of people. So I just think it's important that look, electronic payments are on the rise as cash usage has declined across the globe. I mean, some people don't even take cash anymore. And then our local pizza guy takes nothing but cash. So I think that's kind of interesting. But, I've been to 3 or 4 places this week where they don't take cash. And these are restaurants, they don't take cash. So I that's, interesting. So central banks, and digital currencies, or CBDCs as they call them, in theory, offer faster and cheaper payments, and they allow people currently outside the traditional banking system to access the financial infrastructure. And it could reduce settlement risk and stuff like that, and delays on international trade. But I don't think it's going to happen soon. So I just think that's important. And look, I'm going to go back. I'm going to talk a little bit. We've been talking about this. And they're beating these stocks up, which is great. Okay, so because you want to buy things when they're down, but the next gen AI chips and servers, we talked about, require advanced cooling technology. And I think these stocks are going to get whacked because of the higher interest rates. Okay, 5%. Rob Schleimer has a theory on 5% interest rates and above. And so this cooling system, this data system cooling, area, they're not going to stop AI. I don't think. AI, I think, is where the internet was long time ago. So these companies have great long-term profiles. I think they're going to be weak in the near future. That's just Tim talking now. Some of the charts look kind of questionable, but I think they're going to be very viable very shortly. But the point is that, look, AI has these GPUs and they have chips in them, and the chips run hot. And I think some of the legacy or data center cooling companies have a problem. They got to go to liquid because forced air. It's if you get 125 degree warehouse, it's hard to cool it down with forced air. So the liquid cooling is going to be more prevalent, and we have a great report on it. Look, data center liquid cooling markets is a very interesting, fast-growing thing, and there's a lot of advantages of liquid versus air cooling. And there's 3 type of liquid cooling technologies right now. So I think there's some key players in that space. And liquid cooling should move the needle for several companies that we follow. So anyway, it's a great report. If you'd like to get it, it's called RBC Imagine Data Center Liquid Cooling Market. And I look, these companies, AI is not going away. No matter what the Fed does, I don't think it's going away. I think it's here to stay for a while. And also, if you look at AI, and I'm reviewing this from a couple weeks ago, but a lot of these companies have very strong financial performance. They'll probably be people who have cloud dominance. All of them have made AI investments, and there's a GPU shortage right now. So, that might be that might be the reason some of these cooling companies are backing off a little bit. But they're going to expand data centers. Trust me on that, especially as AI grows. So that's going to be big CapEx growth. And I think there'll be some strategic partnerships, and we have a whole list of who the top AI companies are related. So these are available to you if you like, and we'll take it from there. So, look, the market's having a hard time with interest rates right now, okay? And the long-term interest rates, so we were in what they call a inverted yield curve, and it's no longer so inverted. An inverted yield curve usually means a recession, and a non-inverted yield curve means, usually things are picking up. But, if you look at the S&P 500, there's quite a bit of support right where we are now, and quite a bit of resistance at like the 46.37 area. And one of the things that, Rob Schleimer invented was called the weekly quadrant balance indicator. Now, Rob is our head technician, and he's a really good one. And it's fairly oversold. Matter of fact, I haven't seen it this oversold since 2022, April and July. April we had a big move up, and then we had to pull back into July. So, it's pretty oversold. So, given Friday, it might even be more oversold. So I think it's something that you have to pay attention to. And if you look at some of the momentum indicators, the daily momentum, now quadrant balance is on a weekly basis. The daily momentum on the S&P and the NASDAQ are pretty oversold also. So, look, I think it's something that, everybody's negative right now. We're not negative enough, unfortunately. But now, one thing Rob has talked about several times, and he said that the semiconductors remain an important barometer for the broader equity market. And the third quarter pullback in the SOX semiconductor index is showing evidence of bottoming, okay, in Rob's opinion. And, our expectations is, there's a seasonal low. Remember, we talked about seasonality to some extent here on this show for several weeks now. September's a bad year. I mean, you go back to the 20s, and September is a bad month, just a bad month. It's the worst month of the year. October, the beginning of October, is pretty ugly normally too. But it seems to be a bottoming month. Now, I don't know if that's going to hold this time around, but it seems to be a bottoming month in a lot of the cases. So, remember what they say, go away in May and come back on All Souls Day. So All Souls Day is creeping up pretty quick. It's 10 days away. So, look, I think we view the trend for semis consisting of higher lows and higher lows and higher highs to be intact, and expect the pullbacks to be relatively short-lived. And we think we could rally into the fourth quarter. Now, the relative performance for the versus the stock on the S&P 500 is also looking fairly good too. So, we're in a situation where I think there's a lot of stuff out there that are down. Okay, so we have all these macro and geopolitical headwinds, and equity markets remain on track to probably establish a fourth quarter low through earnings. We think short-term momentum, tracking 2 to 4 week swings, are oversold and bottoming line with the expectations, as the S&P rallied into key support and then rose to 200-day above the 200-day moving average. And then we saw the first resistance around 4,400 and 4,424. We expected the S&P to pull back. It did. All right. So more importantly, I think the weekly indicators tracking 2 to 4 month swings are increasingly oversold for most of the markets and likely to bottom, okay, over the coming weeks. With growth stocks leading the turn, probably, and safety stocks suitably oversold to bounce. I mean, a lot of companies that make food and healthcare have just been crushed because of a certain drug, and that's been cutting diabetes risk drastically. So I think they, we said that we think we've overdone it a little bit there. So, our best case continues to be the equity markets are the early stages of bottoming and heading into, the fourth quarter. Remember the 4-year cycles we talked about. So now, I tell you, let's stop and let's take a break, and we'll come back and we'll talk about the long term. Okay, stay tuned. We'll be right back. This is the Smart Investor Show.
My first ride along was with Jamal, even before I was hired. They wanted me to see everything from the ground level before moving forward, and it was awesome. The first time I came in, I got to sit in on a meeting and never realized that plumbers have that level of organization and sophistication to their operations. And I say that as a former degreed project manager as well as an Air Force vet. After getting out of the service, my wife and I moved to Cleveland, and I just wasn't happy with the corporate-style desk jobs. So I prayed for a sign. That next morning, my best friend called me about this radio ad on the Fish for a company he thought would be perfect for me. And he was right. Wyatt Works was a godsend. You have to want to help people. But if you do, this job is fulfilling in ways that the right person won't find anywhere else. If you want that for your life, call us direct and
Consider it done at WyattWorks.com. License number 30185.
Wallackadoodle.
America is kept safe because the Army National Guard responds, protects, and supports our nation when it needs them most. The Army National Guard responds to disasters such as wildfires and floods. They protect us with missile defense, cybersecurity, and civilian support teams for chemical, biological, and radiological hazards. Be there for your community and your country. Visit NationalGuard.com to learn more about part-time service. Sponsored by the Ohio Army National Guard. Aired by the Ohio Association of Broadcasters and this station.
When it comes to managing your retirement, it's easy to get lost. Look to RBC Wealth Management to guide you. Our experienced, knowledgeable financial advisors will build your investment strategy by designing a plan that's tailored to your unique financial needs. Call Tim Hayes at 216-774-8906. RBC Wealth Management, a division of RBC Capital Markets, LLC. Member NYSE, FINRA, SIPC. Visit rbcwealthmanagement.com.
Okay, we're back. I'm going to talk about the long term here. And look, one of the worst things that you can do is panic. Okay? People panic a lot and they forget about the long term. Now, look, if you're 80, the long term's shorter. All right? If you're 40, the long term's longer, obviously. So I just think that panicking doesn't make sense. So there's a lot of people who, if you listen to certain, TV shows, you better hope there's not an open window. So let's talk about the long term. So U.S. equity markets are nearing on a very important long-term inflection point. As pullbacks through the third quarter approach key levels in the fourth quarter, we got interest rates, the U.S. dollar, they're ongoing headwinds for stocks. Our base case continues to be the secular uptrend and current market cycle remain intact, and with recent equity declines consistent with seasonal weakness. We talked about September being a bad month, with the potential to bottom probably sometime in this fourth quarter, as the technical indicators are becoming oversold and very supportive of the year-end rally. It's hard when you have days like or weeks like last week. Okay, it's hard to think positively. You're supposed to buy low and sell high. Okay, remember that. I've remained somewhat optimistic. A lot of my clients and people who have been called in think I'm crazy, but I went on the air back in 2008 and 2007 and said that cash would outperform stocks. I said it for 6 months. All right, I had people sign up with me and never see. I didn't buy anything. Okay, so I remain very optimistic that since that fourth quarter of 22, given the S&P established a typical 4-year cycle low near its long-term uptrend, which was the 200-week moving average, by the way. And as the intermediate trend indicators became overbought and peaked early a couple summers ago, we had a seasonal pullback was going to be likely. And now it's been helped along by some policies, the Fed tightening, all that good stuff. So, I think there's a silver lining, and the stronger than expected employment reports recently, they pushed the yields up, okay? But almost every sector was weak through the third quarter. Interest rate sectors such as utilities, they got whacked. I mean, hard. It's kind of premature to, hey, we have a major bottom in place, okay? For any of those sectors. But growth groups such as technology have also been weak. So far, their corrections are nearing support and seasonal lows developing in October. Interesting, despite the rise in interest rates, the relative performance of growth versus value has been improving. Growth stocks have been selling off, but not as much as value. And lastly, the energy complex remains noteworthy as an emerging sector following the correction, okay, in 2022. So view energy as an attractive sector and part of our barbell. We talked about value on one side, growth on the other, and growth. So I guess the current trend in interest rates remains the ongoing concern. But remember, we have these generational cycles. They usually last 16 to 18 years. We think, RBC thinks, Rob Schleimer thinks, that we started this cycle in 2016, which, if you put that out, somewhere in 2034, or, that could last in the early 2030s, let's say, okay? So secular uptrends are defined by pullbacks with cycle lows often developing near a 4-year moving average every 3 to 4 years. That's the way it goes. Maybe you forget in 1980, in the 1980s, it was 1987. We had a thing called the crash, okay? Then we had the Russian ruble crisis. Then we also had in the 90s, when we hit 1990, we had the Kuwait invasion. So I think a break below the 2022 lows at the S&P 500, 3,500 level would be needed to have a negative signal, okay? So that's the long term. We're 4,200 right now. So look, these 16 to 18-year equity cycles, the Dow Industrial Index has transitioned from a secular bull market roughly every 17 years, while the bond market has moved in 34-year cycles. I don't know why that is, but it's the cycle theory, okay? So there are a few long-term cycles for bonds. The equity market has reacted to moves above the 4.5-5% level, okay? Now, put differently, the equity market is likely to continue correcting if interest rates stay up, okay? And unfortunately, we don't know the answer to that yet. So, and I'm not going to make any comments on them because the interest rates are tough to figure out. So a repetitive 4-year cycle is, so you have these 16 to 18-year cycles, and within them, you usually have 4 repetitive 4-year cycles, and they tend to be the same. In a bear market, it's a little bit different, but in a bull market, it's repetitive. Now, one of the things we always talk about in this show is a momentum figure, which we look at, and it's the 4-month moving average over the 13-month. When the 4-month is over the 13-month, we're usually in a bull phase. When the 13 is above the 4, we're usually in a bear phase. When there's a big discrepancy between the two, statistically, we'll probably go back to, you'll revert to the mean. Okay, so it's a technical tool to track the trend of the equity markets, and we compare it to short-term trends, but measured the green 4-month moving average by the 13-month moving average. So this is longer term, but since the fourth quarter of 2022, the faster-moving 4-month moving average has turned and crossed above the 13-month moving average which showed a positive, trend. And so the indicator bottomed in the fourth quarter of 2022 and has built up positively into the summer of 2023, but it's showing signs of decelerating. So that momentum, that histogram momentum, was the highest I'd ever seen it in 2021. That's why I kept talking about the bullish percent, going from 80 to 60 and all that stuff. And so we didn't have a lot of great ideas. And then we went to the lowest oversold reading that we ever had. That was when we talked about, the put to call ratio being the highest I'd ever seen it. Now we're up there again. So what we have, on a weekly basis is the stocks are, showing signs of oversold. Same on a daily basis, but on a monthly basis, we're overbought. So we've got to get rid of that overbought, and sometimes it can be done by just going sideways, whatever. But one thing I like is that if you look at the S&P 500 and its relative performance versus bonds, the relative performance ratio of the S&P 500 versus the Barclays All Aggregate Bond Index is beginning to break out. So this is the third year in a row for bonds. If you own the bonds, you got hit in them. Now, if you hold them to maturity, they're fine. But I think, look, we had a strong rally in the first half of 2023. The S&P is pulling back to key support. That's around 4,000, 4,200 where we're now, and then 4,000, which is near its 200-day moving average. So we see the recent pullback as consistent, okay? And it's that seasonality we talk about. September, boy, if you look at all the way back to 1928, September is the worst month, followed by February and May. Since 2000, by the way, it's September, February, and then it's June and January. So I don't know why that's changed. But look, one of the problems we have on the long-term thing is we look at the American Association of Individual Investors and the bullish versus bearish sentiment. And the bullish sentiment is too bullish right now, and the bearish sentiment is not bearish enough for us to make an ultimate bottom. So, we'll take it from there. But, you've got to consider all these things for the long run and most people, are bailing at the wrong time, okay? Mutual fund flows people are selling. They found out with mutual funds a long time ago is that, the average investor doesn't do as well as the mutual fund does because they sell out when they have fear. When you're fearful, you should be greedy. When you're greedy, you should be fearful. It's that simple. So just keep that in mind, and we'll work from there. So right now, like I said, is a good time to start a plan. Our wealth plan is available to you. Right now, you could be doing what ifs. What if the market sells off again? What should I do? Should I put more money in bonds? That type of thing. And I think it's important. So don't forget that. I'll also make another pitch for our healthcare. Taking control of healthcare and retirement got to be one of the biggest things that people can do. All right. So it's got all sorts of hints and good ideas. And then we also have the family inventory workbook. And, getting organized at this point is probably a really good idea. All right. So they're available. If you go to WHK's webpage, WHK 1420 AM, scroll down to the Smart Investor Show. It goes directly to my webpage and allows you to, there's all sorts of things, contact me, email me. We'll send out a wealth plan. We'll send out a family inventory workbook, and taking control of healthcare is really important too. So got to start thinking about the long term. Everybody's so concentrated on the short term. If you listen to CNBC or any of the shows, it's all about the short term. These guys trade like crazy, and sometimes that's not the best idea. I can guarantee you, if you're trying to trade and you're going against some of the traders in New York, believe me, they can turn on a New York City dime. Okay, So it's very difficult to do that. All right. So be careful. But we're going to talk about the short term in a couple minutes. But I think it's important that you know that the long term is still there. People are stepping in and out of the market probably too much. Mutual funds are considered a long term investment. I just talked to a couple this week who sold out of all their mutual funds. Which probably was a good idea for about two months. But look, with a mutual fund, and I had this question emailed to me before the show. The key with a mutual fund is what you want to do is you want to buy. So, what they're doing is they're dollar cost averaging as we go along. So keep that in mind as you go forward. All right. I think it's time to take a break. Let's take a break. We'll be right back.
Bad decisions limit future options. Make bad enough decisions and you'll destroy your life. Listen to The Flatline with your host Rick Hughes every Sunday morning at 6:30 here on AM 1420 The Answer. The Flatline describes a mainline resistance in your soul to build on God's Word. Join us every Sunday for 30 minutes of inspiration, motivation, education, all without manipulation. That's The Flatline with Rick Hughes, heard every Sunday at 6:30 a.m. on AM 1420 The Answer.
Take it from Charlie Kirk.
As I read this New York Times article, so I read the New York Times so you don't have to. Salem Media Group reaches more people than they realize. This is my favorite line of the whole thing. Their hosts are big names, and they have huge reach, which makes them one of the most powerful forces in conservative media.
Tap into our big names to help grow your business. Call Tim Vaughn at 216-525-1818. 216-525-1818.
Thank you for finally noticing.
Wouldn't it be nice to keep income rolling in even long after you retire? At RBC Wealth Management, we can help you invest for the future that you want and create a personalized plan to help you create the steadfast flow of income you'll need throughout your retirement. Call Tim Hayes at 216-774-8906. RBC Wealth Management, a division of RBC Capital Markets, LLC, member NYSE, FINRA, SIPC.
All right. Four Seasons. Oh, no, that's not Four Seasons. McCoy's. I'm sorry. Anyway, if you're wondering why I talked about mutual funds there, is we have new software, and my system went down for about 30 seconds there to a minute, and it happens sometimes. So anyway, let's talk about, I think it's very important, and I was looking at some of the stuff that we used to talk about on this show, and some of those indicators are down pretty far. They're just hovering where they need to go below, which they may have done that Friday. I just have not looked at it yet. But look, if you were a rational person and you heard everything that was going on in the world, would keep your money under the mattress. All right. So the macro and the geopolitical headwinds in the equity markets remain nuts. But this is what bottoms markets. Okay. So short-term indicators, momentum, put to call ratios, tracking 2 to 4 weeks swings are really oversold and bottoming in line with expectations that the S&P rallies from key support, which is around 4,200. And then, which, because it coincides with a rising 200-day moving average, we're right there. Okay, so I think the first key resistance after that would be 4,400 to 4,427. I'm going by Rob Schleimer's work because he's a really good technician. And so I think what's really more important is the weekly indicators tracking 2 to 4 month swings are increasingly oversold uh, for most markets and likely to bottom, I think, over the coming weeks. And, look, it's hard to talk to you about, when things are down, but you may recall I back in March of 2009, I said, I think we've hit a generational low. And people thought I was nuts. I maybe I was, but it was. So it's always darkest before the dawn. And I just think we need to get people a little bit more bearish. All right. Now, our best case scenario, this is RBC's, continues to be that the equity markets are in the early stages of bottoming, heading into earnings season, and we expect it to kind of be a zigzag pattern consisting of the current bounce followed by another pullback potentially into the FO, the 10. I think it's the first week of November is the FOMC meeting. So the equity markets appear to be tracking for a normal bottom, and like I said, seasonally, September is the worst month. It was a bad month, and it's and usually it's the first couple weeks of October are negative, and then we work our way out. Okay, now that doesn't mean we can't have another sell-off of some sort, but like I said, the technical backdrop on a daily and a weekly basis, the momentum is very oversold. And I know that you say, well, what good does that do me? Usually, they're right. Those momentum figures, man, I'm telling you, they work great. All right, so we'll see what happens, but I think the uptrend in yield is a problem, and it's going to be. Rob Schleimer's always talking about what happens when you get over 4.5-5% on the yield. What happens to the market? It's usually not good stuff. And large cap growth is kind of rebuilding its leadership to large cap value. Now, technology did get beat up a little bit last week, and mid-cap growth versus mid-cap value is also improving. So it's challenging its 2023 highs, while small-cap growth versus value is lagging very badly, by the way. Now, the other thing we got to talk about is high beta cyclicals versus low volatility safety. Now, they took a lot of the safety stocks out and shot them because of a drug, that has shown weight. You lose weight and your diabetes goes down. And a lot of these things are beat up. And I think, some are pretty good buys in Tim's opinion. But similar to the growth versus value, high beta versus low volatility continues to show some signs of bottoming near the 50 to 62% retracement of the 2023 rally. Those are numbers that usually are consistent with bottoms. Semiconductors, remain a key driver of this relationship. With there's a growing list of semis becoming oversold intermediate term and showing some signs of bottom. So we'll keep that. We'll hopefully keep that, in the back of our heads. But look. The one thing we have to worry about is the monthly momentum on the S&P is still overbought. So, if you track 2 to 4 year swings, it remains positive after bottoming out, back in October of last year, but it's starting to decelerate. Pause, shall we say. So, I think Rob's expectation is that its current pullback is consistent with seasonal weakness, and it's likely bottoming in conjunction with earnings, and all that good stuff. So what could change our view? A break below the S&P 500 on the S&P 500 below 4,000. And the 200-week moving average is currently at 38.89. That would be needed to suggest the cycle is beginning to fail a little bit. So that would be a lower high is what we're talking about. So we'll see what happens, but the short-term stuff is pretty oversold. So maybe there's a rally first, is what he's saying. But remember, we go back to seasonality. Since 1928, September is the worst month. February is the second. May is the third. Since 1980, October, the first 2 weeks of October have been ugly, and the last week of October is usually pretty good. So keep that in the back of your head, all right? And Rob designed this thing called Weekly Quadrant Balance Indicator, and it tracks the percentage of stocks which peaked back in June and July, and it's now oversold and likely to bottom in the fourth quarter. I don't know if it's going to hit a new low or not. You can't tell that, but as long as we hold that 4,000 on the S&P 500, I think that the seasonal low is there. But if we break below 4,000, that would negate our view, I think. And we always going to tell you about the downside, and it can happen. So the daily momentum is bottoming, and it's turning supportive of a bounce. Okay, what do I do right now? I can't tell you. It's time to get organized, folks. Get a wealth plan. Sit down with me, and we could go over what ifs. I think right now, with the yields being up, it's a good time to buy yield, whether it's a bond, like our bond list. Municipal bonds right now look good. Our CD list, please let us know. Our dividend growth portfolio and our prime income list are pretty important too. And look, the other thing is, I talked about this, healthcare and retirement thing, and it's important. You got to know that that's one of the most important things that's going to happen in the next, the day you retire going on. Healthcare gets expensive, and you got to know what to do. Okay, so it's a good piece to have. And don't forget, AI is not going away. All right. So we have a couple of reports on AI, and I think that's very, very important. So keep that in the back of your head. If you'd like to have an appointment with me, go to my webpage, go to WHK1420, go to local podcast down to Smart Investor Show. Goes right to my webpage. There's also to contact me, email me. Let's have a cup of coffee, or let's just sit down and talk. All right. In the meantime, have yourself a wonderful weekend. This is Smart Investor Show. Don't forget to buy low and sell high.
Thanks for listening to the Smart Investor Hour. To reach Tim during the week, call him toll free, 888-223-7742. That's 888-223-7742. Or visit his website, rbcwmfa.com/Tim Hayes. That's all one word in the address bar, rbcwfma.com/Tim Hayes. Please join us again next Saturday for the Smart Investor Hour to hear more smart investing from Tim Hayes of RBC Wealth Management.